Let's bring in Mike Mayo because we do have bank stocks moving. He, of course, the well-known analyst from Wells Fargo Securities. He's with us via Zoom. Is this a new day, Mike, for what was already, you had this as a pretty good environment as it was for the banks. What about now?
Well, I would call this the bank stock trifecta. It starts with Pfizer Monday 2 months ago. And since that time, bank stocks have outperformed the market by the biggest margin in over a decade. The second event was Fed Friday, which was 3 weeks ago when buybacks were allowed again. And we estimate that banks can buy back 15% of their shares over 2 years with their existing excess capital and the new excess capital. And the third part of the trifecta for bank stocks would be Georgia Tuesday or yesterday. And what that means is the reflation trade is back on. That should help the bank net interest margins. And to the extent there's more spending, that can help mitigate the degree of credit losses. So, bank stocks had the biggest outperformance in history year over year until Pfizer Monday. And now they've had the biggest outperformance for the past 2 months in over a decade, and we expect that to continue. So today is good news for especially the spread lenders.
Well, okay, so Bank of America and Citi are up 7% respectively today. I don't know if that's too much, 7%. Jim Cramer made the point earlier today, Mike, quote, banks have some room to run, but let's remember there's no pot of gold at the end of the rainbow. And he worries about what actually happens when their earnings come out and you realize, their earnings aren't that great. So this move is sort of punked, and then these stocks sell back off. So you're going to have a chance to get these stocks lower again.
Well, look, a lot of people are being very cute with bank stocks, okay? I mean, there are historically low valuations relative to the broader stock market. So you can try to be cute, but then you have something like what's happened over the last 2 months when bank stocks have increased by 1/3 in absolute terms. And again, outperform the market by 25%. And what you're likely to see is that the worst of the net interest margin decline, which has been the worst in a century, is over. And the other thing is that credit losses are likely to surprise for the better. In other words, the losses are not increasing as much as people had expected, even before any potential additional stimulus. And by the way, the gold at the end of the rainbow is where we were before the pandemic. Before the pandemic, banks were doing just fine, thank you. And now they're on the road again. That's our theme for the year, the Willie Nelson song. I'll spare you by singing it, not singing it. But you're on the road again to the best efficiency in the history of banking. And that's with the use of technology. So even without much top-line growth, so I agree with that part of it, expense growth should be even less over the next couple years. So you have efficiency improving, you have credit not as bad as expected. And the other thing, Scott, that you're going to get once banks report earnings, for the first time in over 9 months, banks can repurchase their shares again. So if you get that sell-off that people expect, who the biggest buyer is going to be? It's going to be the banks themselves. This is a new day for banks.